Rick Santelli standing by. Also, Larry Levin at the CME Group in Chicago. Steve Leisman is right here in studio with us. And Rick, what are people expecting for those numbers?
Well, I'll tell you what, for the most part, what they're going to be looking for is to see if the revision is big. And I know that most people say, it's an old number, why does GDP matter? But it does, psychologically, especially when we've been bombarded with the notion that everybody, including our own Fed, thinks that there's pretty much an economic cloud overhead. Now, granted, GDP's a little old and durable goods is volatile, but these are still important to know where you've been. And here's the data, 3.3 on the revision of second quarter GDP, second time around the block. If you look at consumption, upgraded a smidge, 1.7. If you look at the price index, upgraded a tenth to 1.2. Personal consumption expenditure, quarter over quarter, stagnant at 2.1. Let's jump to jobless claims. Are we headed to 450? Not this time. Revised down 10,000, split the difference between 4 and 450, coming in at 4.25. And if you look at continuing claims, which many of us have been paying almost more attention to of late, it's moving into continued cycle record territory at 3.42 million. The response in the marketplace, slightly higher interest rates. You know, that 2-year note's at 2.38. Remember, the old guy, new guy might distort some of your systems. That's about where the auction results were yesterday. And the dollar coming back on that data a bit, especially against the euro and the pound. Woo, back to you.
That's a lot of information, Rick. Thank you for that. Rick Santelli at the CME Group in Chicago. Let's get to Larry Levin, president of secretsoftraders.com. I guess you got to start with the GDP number, right? What's that about?
It's interesting, you know, a couple of surprises. Same thing with durable goods. I guess one thing we got to say is that we really can't trust, economists out there to tell us what these numbers are going to come out, because we just get so many surprises all the time. And as a trader down here, an investor, it makes it pretty tough to really kind of figure things out because there are so many surprises. But it will be interesting. This market, in my opinion, Kyle, is really looking for some good news. It got it yesterday. It looks like it's getting it today. We ticked a little bit higher in the S&Ps. Really kind of been in a range, 1250 to 1300. I'd love to see a breakout above 1300 in the S&Ps and stay above there. These last two numbers, the last couple of days, may help us do that.
Yeah, the bulls would love to have something they can embrace. But I mean, how can they get the upper hand again, Larry, if all the economists say you can't believe anything out of 2Q, durables? I mean, or for June, whatever.
Yeah, well, I would agree. I mean, this market's going to have a tough time going forward. In my opinion, we're probably going to see more bank failures, more write-downs, things like that as we get into the fall. And so, again, with those situations, the market's going to have a hard time. That's really why we've been in this kind of stagnant, congestion, 1250 again to 1300 in the S&Ps. And, even to break out above it, you really need a lot more good news and a lot less write-downs and things like that. It's just, I don't think it's in the cards. I think there's a better chance we'll go lower. Yeah, but, again, a couple days of good news is not bad for some people.
I guess it could be worse, right? I mean, sure. Jobless claims could have spiked even more than instead of going down 10K.
Sure, or maybe even the Fannie Mae news could have been a lot worse than it was yesterday, too. So, there's a lot of stuff out there that are scaring people, but good numbers like this are helping a little.
Okay. Larry, thanks for that over in Chicago, secretsoftraders.com. Appreciate it.
All right, let's bring in Steve Leisman, also Chris Varvaris, the president of Macroeconomic Advisors. Steve, you looking through these numbers. What's the catalyst? Why this big
certainly
increase?
Trade, Becky, but let me just correct something that Mr. Levin said there, which is that the economists had this right, or closer to right, the first time.
The first time around.
They said 2.7. The BEA government reported 1.9. It's back to 3.3. It could yet get adjusted again. This is the second of 3 reads, and then ultimately it's revised further. But certainly exports were a huge catalyst here. But
because of the dollar.
And because of the dollar, among other things. And Rick also mentioned something that's very interesting here, which is that he says it matters psychologically. I think it matters for much more than that. The central question that Wall Street, I think, is trying to debate here is whether or not the crisis on Wall Street is affecting Main Street. And I think we're getting a picture of that here, that at least in the second quarter, with the stimulus, with the exports, it didn't affect it that much. Let me bring Chris Varvaris in here. Chris, your opinion of the importance of these numbers here, that we did a 3.3 in the middle of what was supposed to be a terrible credit crisis.
Yeah, exactly, Steve. Good point. What was encouraging was the number on personal consumption expenditures.
Right.
If I understood it, revised up half a percentage point to over 2%. So that's an indication that, in fact, the rebates probably did add a little bit of kick to second quarter GDP. The 3.3, while it's backward-looking, does mean that there was more income generated in the quarter, and that will carry through to help us a little bit over the second half.
So, Chris, for some strange reason, I started reading Waiting for Godot again, just for the heck of it. It just was kind of a short book lying around. I had a little time. That's what we're doing here. We're waiting for the Godot of the recession to hit from the credit crisis, and it's just not happening.
Well, the economy has clearly been staggered by the three shocks that we've had, the energy price shock, the housing correction, and the credit market turmoil. And it's proved to be incredibly resilient. Our fear, however, is that while we're staggering, we're now in a sideways waffle, our fear is that we remain teetering on the edge of recession. Our call is that we'll narrowly avoid it, but, it's a very close call at this point, and particularly when we get past the period when the rebates might be giving us a little support, we could see the fourth quarter, again, like the fourth quarter of last year, be a negative GDP quarter. It won't necessarily mean that we were in a recession, but it just means that the economy is just still staggering under the weight of these three massive punches that it's had to endure.
Hey, Rick, yeah, when can we give up the ghost on this? Are there guys down there, Rick, who are saying, you know what? We got to get off of this train here. We got to start thinking that maybe we can make a bet on the resilience of the U.S. economy.
Listen, you're reading Waiting for Godot. You know what Wolfman said?
We're waiting for Atlas to stand up straight.
Yeah, we're waiting for Atlas to stand up straight. Atlas has been shrugging too much. You know what? I think that we are in some ways on the mend because the funnel of the credit crisis is now into the big parking lot of the GSEs. We still see that Wall Street cannot see through. They're under 20 feet of water. The surface looks a little blurry. Look at the data. You're getting as much honesty there as you are from analysts.
Chris, let's talk about the inflation numbers in here. What did I see? The PCE deflator was pretty elevated. How much concern about inflation is inside this report, Chris?
Well, you have the advantage of having all the numbers in front of you, and I haven't seen them all yet. But clearly, the impact of rising energy and food prices have been pushing consumer prices higher. In addition, the decline in the dollar has been contributing to that. We've seen the dollar rally a bit over recent weeks and months, and so that we expect will help to subdue the price increases in the consumer area. In addition, energy prices obviously are well off their highs. Oil's down from $146 in July, and that's helping. Food prices are backing off. So the story here is that we've got a period through the middle part of the year where inflation was expected to be somewhat elevated as some of these prices were coming through to headline. But as some of these factors that were very important in pushing headline inflation up reverse, then headline inflation will in fact come back towards the sort of low 2 range. And more importantly, what we're seeing is that inflation expectations still remain reasonably well anchored. Core inflation rates, while have been elevated, they're really coming in probably better than we expected, probably better than the Fed expected. So far so good on the inflation front. The economy is, while we got a 3.3, which is a nicely above trend number for Q2, we expect that in the second half of the year we're going to see something sub 1%. So we're building some slack in. The unemployment rate's on the rise. Inflation will be, we think, subsiding.
Hey, Chris, it's rare that, from an economics point of view, you have a theory that is shown to be so explicit, and that theory is the benefits of free trade. And in this report, what we see is the contribution of trade to growth is 3% when it comes to the contribution of net exports. I don't like to do this. I'm going to step out, and it strikes me that the benefits here show the president has been right on this trade issue, and maybe some of the folks on the other party not necessarily so right. If you see a 3.1% contribution from trade and a 3% growth rate, that means we would have been growing just 0.2.
Is it being in Joe's seat? Is that what this is? It's like a turning you Republican, look, like the Spider-Man
One of the few
thing?
Opportunities I ever had to meet the president, we got to talk about free trade. And the guy was very smart about free trade. He seemed to really get all the issues. Go ahead.
Let's remember, Steve, that the growth of trade globally is a secular trend that's been ongoing for a long time, and there's been bipartisan support for bringing down trade barriers. That's how we had all the past trade bills passed, including NAFTA. So I think that the debate that we're seeing on the political side now is more about changes around the edges, not whether we should have fair and open trade.
Rick, let me ask you how the markets are viewing this report here, especially because, what we care about here is not really the past. We're kind of finagling around with the kind of details here. What is the market taking about the future from this report, Rick?
Well, you know what? It's pretty clear, actually. The markets are moving back to unchanged with Treasury, so their theme of they're still not convinced is intact. The equities, like after durables, are holding on to their gains. And the dollar, though choppy and not really a huge move, is holding up pretty well. And, you know, there's a lot of people on this floor, Steve, that agree exports are important. But once you burrow the tunnel, you know, even if the dollar value starts to slip, a lot of the logistics are in place for bigger trade by the U.S., and those positives don't go away.
I'm getting the Steve, you're done thing in my ear, so I can't ask Chris about his 3Q and 4Q forecast.
No, you can't. Goodbye.
I can?
Bye, Chris.
Okay.
No. Goodbye, Steve.
All right.
Next
Mike,
time.
thanks. We'll get Chris back on. Chris Varvaris from Macroeconomic Advisors, and there's my man Rick Santelli down there, holding down the fort of the entire bond market.
Waiting for Godot.
Waiting for Godot.
Wow.
It just was there. And,
It's a short book, at least.
It's a short book.
You can finish it.
I don't think I understand it.
There you go.